The debt market versus the equity market. Of course, we all know about the equity market, that is stocks, but I want to talk about the bond market because I don't really hear a lot about it, but it's super important. It's much bigger than the stock market, and it has the potential to absolutely crush the economy. So let me talk about the differences and the similarities, how they impact each other, and what I mean when I say that they have, the ability to kind of dramatically affect what the economy is doing. So stick around for all that and more. It's Crystal with the Cash Compass. All right, welcome back. I am here to teach you all the things that you should have learned in school about money, but for whatever reason, they forgot to mention it. If you love all things personal finance, investing, and economics, you're definitely going to want to subscribe. It's down there somewhere. When you're down there, make sure you hit the bell too so you can get all of my notifications. Let's get into it. All right, so like I mentioned in the beginning of the video, the bond market is actually dramatically larger than the stock market by a lot, okay? And from some sources that I've seen from 2016, the bond market was actually $100 trillion in the US compared to just $20 trillion for domestic stocks. So, I mean, we're looking at like a 5x difference, right? So, even though these two things are a little bit different, they are definitely interconnected. And it's not only just stocks and bonds too. I mean, you can think about precious metals and commodities. So if you were to go, and I'm looking down because I'm recording this, but if you were to go on like CNBC, I believe Yahoo Finance, any of those type of like investing type websites, you'll see a couple of things at the top. So like if you're looking here, we have the US and the European bond market as well as the Asian market, bonds, which is our debt, oil, gold, cryptos, and FX, foreign exchange, right? So all these things are pretty much connected. Like I've mentioned in previous videos, there is no like money heaven, there is no money waiting room. So when you see money kind of leaving one of these, sectors, they're typically going into a different sector, right? So a lot of times you'll see, like if you see the bond market, for example, if you see the yields going up, that means that people are leaving the bond market. And I'm going to actually explain that in a little bit. But when they leave the bond market, that money is not just sitting in a waiting room, okay? It's going somewhere. I guess you can consider a savings account like a waiting room. But the point is, typically people who are pulling money out of the stock market or the bond market or crypto or oil, it's going to go in one of those other sectors, okay? So you might see sometimes like maybe the yields are going up in bonds, but then the stock market is also going up, right? Because that means money left the bond market and it's going into the stock market. So a lot of times you can use like the 10-year treasury bond to kind of gauge where we're heading as far as stock market goes. But I'll talk about that in a little bit. All right, so let's start with the bond market because that is the asset that does not get as much attention. Like, of course, you'll hear it here and there, but people are just so crazy about stocks. And I guess it's a little bit easier to understand and conceptualize, and it's easier to access. But the point is the bond market is just as important. Just so that there's no confusion when I'm saying a bond market, I just mean debt. It's essentially just taking out a loan, but we just call these things different names. Why? I have no clue, but there's plenty of flavors of bonds. There's corporate bonds, which will be like, your Amazons, your Targets, like how they get their debt. There is treasury bonds, which is the U.S. government. There's municipal bonds that are like, those are at like the city level. I mean, there's a whole bunch of different type of bonds, but they're all kind of the same thing. You might hear things called notes too. Notes are also it's all debt, all right? A nice, cute way of saying debt. People tend to think bonds are safer, and I think when they say that, they're talking about the treasury bond, because if you ever heard something called the risk-free rate, that's basically the rate that the treasury bond's going for, and they say it's risk-free because it's from America, and America prints their own currency just like all these other countries do. So it's risk-free because it's like you're more than likely going to get your money back. I mean, it's unlikely that we would have a hard default in the US, and when I say hard default, I mean like they're just not going to pay you. I don't see that happening. If we were to ever be able to default on our debt, it might be a situation where our money is so hyperinflated that you might get your money back, but it's not going to be anywhere near the purchasing power that you would have when you initially got that debt, right? So like, let's say you had a bond for $1,000 and it was a treasury bond, okay? If the US was in trouble, they might not absolutely just default and say, hey, we can't pay you back. You might get your $1,000 back, but whereas right now $1,000 can get you a lot of stuff, maybe $1,000, if it's overinflated, will get you like a loaf of bread. And that's a dramatic example, but that's literally happened in different countries around the globe due to this fiat currency system, which I don't want to get off topic, but that's basically why it's called the risk-free rate, right? Another thing about bonds is that when you are a bond holder, you are more likely to get your money back than a stockholder, okay? Because when like let's say you did a corporate bond. So I was talking about treasury bonds just now, but like let's say you loan money to Amazon or something and they were to default. Typically when you're going through bankruptcy court, bondholders tend to get paid. You are almost not, you're not guaranteed anything if you're a stockholder, okay? Because you just put your money in the full faith that the company was going to keep on growing. But as a bondholder, you extended this credit to them and you're supposed to be getting paid back. Now, I don't want people to get confused. When you go on to, any of your finance or investing websites, you might see like a percentage, right? That's the yield. The annual yield. So right now the treasury bonds are at like, 1.75 or something like this? 1.73, right? So it's 1.73 right now. That means if you were to hold that bond for an entire year, you would get 1.73% back on your money, which sucks. Honestly, these yields, you wouldn't be able to live off of them, right? Like you have to figure out something else because unless you're putting a lot of money into the bond market, that's kind of tragic. But that is not to be confused with the price. If you see the yield going up, that means the price is going down. The yield, which is your return, and the price of the bond have an inverse relationship. If the price is going down and the yield is going up, that tells you that people are actually leaving the market, right? So another way to think about it without being confusing is if you see the percentage going up, that's because people are not checking for the bonds, okay? So in order for them to kind of get more people interested, they're going to raise the yield. And that's kind of like elementary of how it works, obviously. It's like they'll go out into the market with like maybe 1.6, and if no one's biting, they have to go up to like 1.65, 1.7, 1.75, right? So as investors kind of move out of the bonds, that'll drag the price down and then drag the yield up because we're trying to attract some more people back in with a higher yield. People tend to panic when they see the yield going up. So you probably have heard that because I think at the beginning of the year, I don't know, the 10-year yield has been going up like crazy. Like 2020, it was actually just on a downward trend, but lately it has been going up and up. And the reason why people tend to get a little bit nervous about that is because they tend to kind of dictate the other interest rates, right? So if the 10-year yield is going up, then we would expect to see maybe mortgage rates going up as well, maybe auto rates going up as well. They're not necessarily connected where they all have to go up at the same time, but typically you would see that, okay? Same thing with the federal funds rate. If the federal funds rate, and I don't want to get too technical, but long story short, if it's cheaper for these banks to borrow money, they could actually pass those savings on to the customer, which they are incentivized to do because they could take some more people out, into their business, right? So like if we have Citibank and we have Bank of America might say, listen, I'm going to give my customers 2% because Citi's doing 3% and I want to kind of take some of their customers, right? So they're incentivized to do that. But just as it can work that way, it can work the opposite way where it's like, okay, well, we're paying a little bit too much to service our debt, so we're going to kind of transfer some of those costs into our customers as well. In this environment where we have had low rates for literally about a decade, it is extremely important to keep these rates suppressed, which is why the Federal Reserve has been buying up a whole bunch of assets, because if you buy the assets up, that's like a fake demand, right? So like, let's say you were selling apples, except your apples suck, right? And no one wants the apples. But then you have your grandma who's like, it's okay, baby. Like whatever apples you make, I'ma buy them. That's fake demand, right? No one really wants your apples, but for some reason you're always selling out because your grandmother has your back, okay? It's the same situation here. They're trying to suppress these rates, so they are acting as a fake demand, right? A fake buyer. They don't necessarily want to invest in, or they believe in America or whatever, but it's just to keep things suppressed. If the bonds raise too high, that will affect everything. Like I said, you'll have your housing rates going up, you'll have auto rates going up. All of a sudden it's becoming a little bit more expensive to service debt, right? And that can actually have a downward pressure on asset prices. No one wants to see their home going down in value, right? The Federal Reserve and the U.S. government, they recognize that people kind of associate their wealth with how expensive their house is, like how much their house is worth now, or how high their 401k is going, their stock portfolio. So it's really important for them to keep those assets propped up. But if we have debt that's too expensive to service, we're not going to see high asset prices because people are going to have to spend some more money servicing that debt. And I kind of got a little bit off topic, but that's just, a little extra information. Another thing about the debt getting too expensive is if it becomes too expensive, and we have so many corporations. The last time I looked at this number up, it was something like 25% of companies actually are zombie companies, which means that they do not make enough money to actually earn a profit, right? They're running losses every single month, every single year. 25% of companies outstanding are like that, okay? If we run into a situation where there's more companies getting like that and the interest rate is going up, they might be downgraded, because if you didn't know, companies get rated, right? And triple B is the absolute lowest that 401ks and like these kind of like retirement plans can have. If they don't have a triple B rating, you cannot hold those things in your pension or things like that. So they will have to sell those, which is obviously not good, because if you need money in order to keep your business running because you don't have a viable business model and you literally only survive off of debt, eventually it's going to come to a screeching halt if no one's going to extend credit to you anymore. So, I mean, it's super obvious why that's a huge problem. But before I get into the reasons why this can actually crash the economy, I want to talk about the stock market, which we all know about the stock market, but I just want to give a couple of, extra details. So there's different ways for companies to raise capital, right? So like I just described, going into the bond market is one way, but having stocks is another way. When companies do go this route, though, it's maybe a little bit less predictable of what the outcome will be, right? So if they're going out into the market and saying, hey, I need $100 million, right? And they get a bond, they're going to get that money as long as somebody is willing to extend that credit to them. When you're issuing stocks, you can issue a certain amount of stocks, but there's no guarantee that people are going to actually buy that up. And there's also no guarantee that they're going to buy it up at the price that you think it's worth, right? So they can IPO. Like I know maybe you'll hear this where people like IPO and they're like, yeah, it's going to go to the moon, but it actually drops dramatically, right? Those type of things, you can probably try to gauge how low it's going to go, but you ultimately do not know. So it's a little bit more unsure. Of course, they have experts who are calculating and trying to figure out how much money they can raise by issuing their stocks, but it's just not as black and white as just saying, hey, I need this amount, amount of money. Let me take out some debt. It's a little bit different. And of course, when you issue shares and you're buying shares of a company, you technically own a portion of that company, right? So with that also is some different type of demands. As a bondholder, like when you have extended credit or loaned money out to these corporations, you just want to get paid back, okay? But when you have stocks, the anticipation is the stock price is going to inflate. Maybe it'll pay dividends eventually, but the point is you want to see some results. You technically should have faith in this company and you want to see it grow. Now, I think, it's become a little bit more speculative these days, but that's kind of like the foundation of it all, right? So if companies want to loan money out or get money, if they want to raise capital, they can issue stocks, but it's a little bit less easy to calculate, and it also comes with a little bit more responsibility because they want to keep on increasing their earnings. You want to have a high earnings per share and things like that. But like I said, the stock market has become extremely speculative, and it's not what I think it was intended to be, which is people who are literally researching companies. They look at their business models, they agree with, how they're running their company, and they want to invest and they want to actually be a true owner of the company. Now it's like you just see something on Reddit and you're like, oh, okay, let's screw the big man. Like, let's just buy up all the stocks. Who gives a damn about GameStop? Like, I don't care. I want to just make these gains, honey. Okay, gains don't stop. And with this whole euphoria where stocks just seem to be going on the up and up, I can understand that. At some point, it's like, listen, forget the fundamentals, forget the, all this other BS. Like, I just want to make some money, which I'm not mad at. Like, I'm actually here for that totally. But it just takes away from the essence of what investing, in my opinion, is. So how can this all blow the F up, okay? The Federal Reserve, and I'm going to have a video coming out this week talking about the Federal Reserve and what they kind of just announced. But the Federal Reserve basically, in so many words, has said they are going to continue stimulating this economy at least until 2023. Like I said, I'm going to have much more details on what I mean by that. So definitely make sure you're subscribed and hit that bell. But with that piece of information, what we can say with a pretty good amount of certainty, obviously I don't have all the answers. Don't come back here getting mad at me, okay? Because I'm not responsible and I'm not liable. But we can pretty much expect that stocks are going to go up. It's not going to go up in a straight line. Nothing goes up in a straight line. There's going to be some pullbacks, but we can pretty much expect that. So when we're thinking about like market crashes or when are we going to see the bottom, it might be a melt up which is what we saw in Venezuela, where their stock market was like the highest and best performing stock market in the world for a minute, but it was melting up. So it wasn't a crash that we're typically used to, like back in 2008, where people's houses were like literally slashed in half. It might be a situation where, because there's all this fake demand, right, because of your grandma's buying all them apples, it might look like you're doing better, it might look like you're growing, but you're eventually going to come to a screeching halt. And with that example with your grandma, maybe your grandma was like, listen, I didn't get my SSI check, I didn't get my UBI, I didn't get my stimulus check, so I can't buy any of your apples this year or this month or whatever. And you're gonna see like a crash towards the end, right? Like it eventually comes down, but that's a melt up, where it's like all this fake demand, all this extra money they're putting into the system, that just kind of puts a false impression of growth. It's really not growth, it's just manipulation. We have become addicted, and not me and you. When I say we, I'm just talking about the society, has become addicted to super cheap rates, easy debt, easy, money, basically free money, right? Especially after you factor in inflation. Yeah, you're pretty much getting paid to buy a house. If your house is at 3% interest and inflation is more than that, because let's be real, it's not 2% that they keep on telling us, right? So if you have a 3% mortgage and inflation is really 5%, you're basically getting paid to live in that house, right? I mean, obviously it doesn't feel that way, but that's essentially what's happening. So when we have all this kind of like false demand and the fake buyers and this, they're kind of pushing prices up, it looks great, it feels great for right now, but eventually it's going to come to an end. And with the bond market, if we do end up seeing prices go up, because the Federal Reserve can do whatever they can to try to suppress the rates, but it's not as easy as saying, okay, guess what, guys, the interest rate now is 2%. No, they have to keep on buying up assets. But if people start losing confidence, they start like losing faith, the free market will win again. And if they start charging more money for these corporate bonds, or the Treasury bond keeps on climbing, that can also have a dramatic effect, because people won't be able to service their debt anymore, right? So we kind of have to keep these prices suppressed. That's why the Federal Reserve basically said we're going to keep on buying stuff. We want to make sure that these prices stay down. We don't want anybody getting scared, because once that happens, you could see a crash. And that to me would be a kind of crash on the downward side, where it's like it's kind of in your face. Prices are dropping. Home prices are going down. Assets across the board are going down because of the bond market kind of crashing. So I definitely think the bond market has a bigger influence, and it's more likely to crash the economy. I can see the stock market melting up. I obviously, again, I don't have a crystal ball. I wish I did. But all these things that they're trying to do to just keep it propped up makes me feel like it will continue to climb until they, start to try to back away and stop giving us stimulus. But what do you guys think? Do you guys care? Because this is kind of boring. I know I seem to like it, but I want to hear from you guys. Do you guys think we're going to have a melt up or a crash? Let me know your thoughts. But that will do it. If you like this video, please be sure to like this video and make sure you share it with all your friends. And if you have nothing else going on, you know what to do. Go ahead and binge watch me. And until next time, keep your money up.